Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, May 31st, 2017. It is about 10 till 2 Eastern Time right now. As I'm starting this video, it's been quite a while since I've done a video, especially on broad market coverage, relatively speaking, and that has to do with the fact the market's gone nowhere. Volatility's dropped off to multi-year lows, and there just hasn't been much to report, anything new from any new technical developments. However, I think it's time to do a video, and this one will actually be pretty quick. I'm just going to go over the charts of the SPY and QQQ on a couple different time frames, and then wrap up with a quick look at some of the risk-off assets like treasuries and gold, and wrap this one up. All right, this is the SPY daily chart. And a lot on here, but really all we need to focus on right now are the most recent divergent highs. We did have divergence, and I believe I would have pointed this out back here. So in other words, this line would have been drawn at that point, and we eked up. We made a marginal new high, and if you guys do recall in the last videos, or at least I know on static posts about a week or so ago, particularly focusing on the QQQ, I was calling for one more marginal new high, and we did get it. We got it there both on the SPY, as you can see, as well as QQQ. And so what we're looking at, if we really zoom in and look at the PPO, the MACD will look similar, as well as the RSI. They're starting to roll back over. And so what we've done is we've just put in again, what I refer to as a marginal new high, a slightly higher high. Still a divergent high. Once we have that bearish crossover on the PPO, that high will be divergent high will be confirmed in my book. And here's your key levels. We have a support level here about 231.79, give or take, and then it's trend line here. This is a trend line off the early 2016 lows. So that's intersecting support. I like to see that when you have more than one support level come in. There may be some Fibonacci retracements there as well, but so I'm looking for something like this. And volatility has been so low lately, with pretty tight trading range, at least over the last few sessions, that we could see a quick move. So I'll be looking for something like this, a reaction there. And based on the scope of these divergences, my outlook has not changed. I'm still looking for a significant correction in the market, despite the fact it seems resilient. I've talked on that in recent weeks. You can look at this glass half empty, or glass half full, depending on whether you have a bullish or a bearish outlook on the market. The bulls might say this market refuses to go down, while the bears say the market refuses to go up. Here we are. This is a SPY, by far the most representative index of the U.S. stock market. I believe it includes 80% of all market capitalization of the U.S. stock market is included in the S&P 500. So a much more indicative measure of the overall health of the economy and the stock market than the QQQ. And the point I'm trying to make, which I've made before, if we look at the crosshairs, a pop-up box on the left, back on Wednesday, March 1st, the SPY hit a high of 238. Oh, no, there it is, 240.32. If you look at the pop-up box up in the top. And we're at 241.06. So basically, we are trading today almost exactly where we were 3 months ago. So again, my point is impressed. The market's gone nowhere. We have made a slightly higher high. Now we're back to where we were 3 months ago, and we have a pretty clear negative divergence. And those divergences show as well on just about every index. Here's QQQ, negative divergence, divergent high, waiting for that PPO bearish cross as well. It's still the daily chart. Small caps, we've had very steep divergences. We had a divergent high back here, and it did play out for a correction. I think that was a drop of about 6%, if I'm not mistaken. Pushed up, made a marginal new high. And so you see the common theme is we have these multi-month trading ranges. It's actually a lot longer in the small caps. That trading range extends, pointed out on the weekly or monthly Bollinger Bands. I think it was a weekly. It's the lowest they've hit, I believe, in history. This is 6 months of very tight sideways trading in the small caps. So, but again, big caps are much more important. They make up much more of the stock market. So, you want to focus most of your effort on the SPY and the, to a lesser extent, QQQ or the Dow Jones. And there it is. So across the board, I don't care which U.S. index you look at, any of the broad indices have clear negative divergence. And again, they seem to have stalled out here. Had they not had these divergences, I might say this period of consolidation is just as likely to break to the upside. But because of the divergences, deterioration in breadth, everything else I've cited in recent months, I still strongly favor the break of this trading range to come to the downside in the coming weeks to months. All right, so let's just zoom down on a couple other time frames. 60-minute chart. This chart's pretty busy. Let's forget about all these trend lines. I haven't had time to clean this up. I just wanted to get this video out. We had a divergent high right here. You can see the divergences with these lines marked. At this point, there's the divergent line right there. And we had a nice pullback, healthy pullback in the SPY. Looked like that might be the start of something more, but we pushed up, and again, I talked about it a couple weeks ago, looking for one more marginal new high, and that's exactly what we had. And as I mentioned back here, that any marginal new high that the market made, unless it kept powering up and burned through these divergences, I made mention back here that any new marginal new high would be just another consecutive or an extension, if you will, of this divergent high, and that's been the case so far. So right now we're back testing the breakout in the SPY. So this is a pretty important technical juncture. You can see here we had these two previous reaction highs, another one there. There's a breakaway gap. So if you're bullish, or well, let's just forget about what you are. Here are the facts. This is a back test of a breakout. These three highs. Again, we're looking on the 60-minute chart. So if this market has legs, the bullish scenario, and if you are bullish, you want to buy here. That's a back test of a breakout. This is a very objective level to go long if you think the market's going up. Personally, I think this will prove to be this recent breakout here. Let me shade it for you. You can see it. I think that'll prove to be a false breakout, aka bull trap. But let's watch. Let's see what happens. We may dip a little bit below, but here's the support zone. The way I want to put this is the farther down we come back below this level, ideally the market should hold this support level here because that is certainly support. It was former resistance. Now it should act as support. And so that would be the healthy bullish case. That would also help to take out or negate these divergences that are in place by making a higher high in the indicators and oscillators below, thereby wiping out the negative divergence. But the more we come down through here, the more that just confirms these divergences, confirms that this was indeed a false breakout, and that would be bearish for the markets. Let's go down to the 10-minute chart. I put up a chart of this recently. This is what's happened since last week. This goes back. You can see the daybreak lines here. This is Thursday. So pretty much as of Thursday of last week, the market stalled out and went in a very tight trading range. I think that was about 0.0, about 0.15% from top to bottom, somewhere around there, excluding these little spikes, but a very tight trading range. It makes sense. Holiday weekend was coming up, so there's Thursday, Friday, Tuesday, which was the first trading day of the week. And so now we've broken down below the trading range. And as highlighted this morning, when we broke down, we were right here. We've backfilled that gap. And, I said we'd probably get a bounce, and then this was a very objective short entry identified right at the time, about as objective as it gets. So you had a breakdown out of a trading range, a bounce back to the bottom of that trading range, which of course is resistance, former support. And so far we've just floundered around between this support level and this resistance level. On a very near-term basis, this is a battleground between bulls and bears. If the bears can take out that support, takes us down here to the next support level around 240, 24-ish. And if we can break back above, get up into the trading range, and especially above the trading range, that would be bullish. This would have proved to have been a false breakdown, i.e. bear trap. So let's just see what happens. I still favor this scenario. And again, we're zooming down here to a 10-minute chart. This helps to see what might happen in the near term. So if we do break down or we break out, then you go back out to the 60-minute and daily charts and then take a look at there, because the technical developments on the longer term time frames are more significant. You tend to have quicker signals on these shorter term intraday charts, but they tend to lead to more whipsaw signals. So it just helps give us a gauge where we might be headed near term. All right, let's just flip it around, look at QQQ, and then we'll wrap up and look at the two other the risk-off assets that I mentioned, treasuries and gold. So here's QQQ, and you had a similar trading range since last Thursday, very tight. And what's interesting in QQQ, I should say the trading range ends up here. In the Qs, we had a pop, a very impulsive pop above it at the morning, followed by an even more impulsive fade. You can see, look at that fade. We immediately faded all of that and then some, fell down below the trading range and popped up to roughly the bottom of the trading range. So that in itself, unless they can undo that, this fade right here, in other words, this is the level I'm watching. I will be concerned with the short positions I have, if the Qs can move back above today's reaction high. It has no business doing so. If it does, it just shows there's a lot of buyers in this market to be able to absorb that pretty bearish technical action. And again, that's a 10-minute time frame, so hard to read too much into it, although right now in a period of low volatility, this is what you have to look at, because there aren't many new or significant technical developments out on the daily time frame or whatnot, because volatility is low, prices have compressed recently. Here's a 60-minute chart, just as with the SPY. We had a divergent high back here, which was pointed out. There was your correction, a little pullback. There's a divergent high there, pullback. Second, more powerful extension of that high, bigger pullback, and yet this is that what I was talking about a week or so ago, looking for a marginal new high in the Qs, and that's exactly what we've had so far. There's a minor uptrend line. I should point out here, this is really the most recent divergent high at this point. When you follow the crosshairs down, you can see how the PPO has made a bearish cross, and just about all the indicators are either at equal or lower highs, putting in that negative divergence. All the lines here are potential targets, whether you're a short-term trader, or they're key support levels to watch. And if you're bullish and you want to go long, then you can look to go long on any of the, pull back to any of these levels. But again, my preference based on the divergences on the longer, more important daily time frames, still keeps me tilted to the bearish scenario. All right, and finally, let's just look at the daily chart. Here's the Qs on the daily chart, same pattern that we've had for years now. Yes, the primary trend is up, there's no arguing that, but you can trade these corrections, you can trade long in the divergent lows. We had a divergent low back here, or you can go short on the divergent highs, and this is what we're looking at. So we have, as I said, negative divergence on the daily time frame. We had divergence here, we had a little blip, put up, made that marginal new high. We're starting to roll over here on the PPO, certainly on the RSI, and let's just keep an eye out and see what happens. These are your support levels, these lines here, and this is the big one, this yellow uptrend line that I'm watching. So at the very least right now, I'm looking for a pullback down here to around that 120, we'll call it 129.50-ish level. This uptrend line, by the time we get there, may come in a little higher, but that would be a decent pullback from where we're at now. You're talking about a drop of 8% or so, and we'll just have to take it as it comes from there if we get it. And again, if we continue to push higher, these divergences would soon be taken out. We will no longer have negative divergence, and that certainly dampens the bearish case and strengthens the bullish case that we're going higher. Risk on, risk off assets. Okay. We know I didn't touch too much on it, but IWM is really the king of the risk-on indices, the small cap stocks. They tend to move higher, go up more, during periods of risk-on. QQQ tends to rise more than SPY. The small caps have really been coming down lately, significantly underperforming. Here's gold. Gold has been resilient. I pointed out recently, something to be concerned about with the 60-minute divergence. We had a divergent high here and a rising wedge breakdown, and it broke down, but look at that. So far, that breakdown hardly played out. It didn't even meet the projection of the wedge, and gold is powered up. It's made a new high. Now, it is still at this point, there's potential divergence. These indicators are pointing higher. Those divergences could be burned through. We could go down. There's still, if I'm not mistaken, the GDX long trade is still active on the site. I left it on with the stops that I originally put there. Personally, I'm out of it. I'm just standing aside right now. But I just wanted to say that I would rather be long than short gold or the mining stocks right now. Particularly gold. During a market sell-off, sometimes you'll see that gold can actually outperform the miners, especially if the market's having a pretty impulsive sell-off. Sometimes the miners get dragged down with it because technically speaking, they're equities. But either way, that's gold. And again, that's the 60-minute chart. But when we look at the daily chart, you can see this was resistance's previous reaction high back here. We've taken that out. Next stop, we have to take out this reaction high from about April 18th or so, and that would be bullish. Not much else. We had negative divergence here, only on the PPO, not on the RSI. I pointed that out, and that did play out for a healthy correction. So, and I think we went long somewhere back in there with the miners. So gold looks more bullish than bearish to me, is what I'm trying to get at here. TLT. I've made mention. I'm watching gold and the treasuries because that's where institutions move. The smart money goes when they either suspect a correction's coming or one is in play, and we've seen strength in treasuries recently. Here's TLT. Really, what I'm watching for, most importantly, when I put the crosshairs here, that is that reaction high back from April 18th. If we take that out, you can see it right there. That would be bullish. That would be a new high. Actually, a new high for 2017. If we take that out, and there's a pretty thin zone. If you look back here to the left, you can see there's a big gap right there, and then a quick sell-off. So this whole area here, I'll just shade it this way, that's a pretty thin zone. Not a lot of trading has occurred. We didn't have any trades in that area other than that brief swoon down there right after the gap, going all the way back to early 2016. And thin zones work a lot like gaps. And of course, at the top of that thin zone is a gap, and meaning they tend to get filled relatively quickly. So if if treasuries break out above this, that April 18th high, especially with conviction, there's a good chance we could see a quick move up. Now, this aligns with my thought process about a pretty swift correction in the market. So, the two would probably go hand in hand. Sell off in equities, like I talked about, if all of a sudden the selling starts to accelerate, as well as a pretty quick move in treasuries. And as of now, just stripping it aside, if I look at this chart, it looks much more bullish than bearish to me. We had, the bigger picture, as pointed out before, we had a divergent low back here, strong bullish divergence, positive divergence. We had this basing pattern down here. Treasuries based, since late 2016. And although the top of the base isn't super well defined, I do have this downtrend line here. We've seemed to have moved above the top of that basing pattern. And again, that's why I'm watching that previous reaction high. I'll wrap up with this. There's a lot of charts that I post within the trading room. Not sure if I might have posted this one on the front page. This is just the recent price action in the last couple week or so here. This is a 5-minute chart, and what I have, you can look up top to see the color coding. This is QQQ is here in black, then the S&P 500 in blue, IWM, the small caps in red, and the Dow Jones Industrial. Look at the disparity here. I need to put that line. Okay, now what this is, I put that line where they all start back here on, looks like May 21st. And you can see as the most of the U.S. stock indices typically move in relative synchronicity, not point for point or percent for percent, but one goes up, maybe they all move up. Starting about May 25th, there's been a huge disparity. And again, it has to do with those FANG stocks, FAAMG, Facebook, Amazon, Apple, Microsoft, and Alphabet or Google. Um, they have just carried the Qs up, and that is not healthy price action for the market to see just a handful of mega cap overweighted stocks doing all the heavy lifting. In fact, you can see from that time, now we've given up with today, just as of today, with that sharp swoon down earlier. You can see at one point the Qs had gained about 2.5%. While at the same time down here, the small caps were dropped 1.5%, 1.2%. Again, from this point back here, that's a huge disparity. And here, right here, you have, of course, the Dow and the S&P move, largely together. They're both large cap, more diversified blue chip stocks. So those two indices will almost always come close to mirroring each other. But I'm just looking at this huge disparity. It's not very normal, and it's a red flag. Especially you can see the small caps, the risk off or risk on, risk off. Right now it's risk off. It has been. Small caps have been selling down sharply while the Qs move up, and you can see the SPY and Dow Jones Industrials have gone almost nowhere. So those are the things I'm watching, guys. If I see any new developments or anything I missed, I'll get that out there to you. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.